Auditors use different tests and procedures to confirm the validity and accuracy of financial statements. Some of the main ones are customer confirmations that compare what the company says a customer owes to what the customer says it owes, vendor confirmations that compare what the company says it owes a vendor to what the vendor says it's owed, bank confirmations that compare the company's bank balances on its books to what the bank says the company has on deposit, inventory counts that compare the physical inventory on hand with what the books show, evaluating internal controls, which includes management and employee interviews and testing controls against standard operating procedures, assessing fraud risk, which includes identifying potential fraud risks and procedures to address those risks, and determining whether the company's accounting policies are in accordance with GAAP. Auditors aren't required to examine every transaction for every account. For example, they don't count every item in inventory. Instead, they rely on sampling. The sample size will be influenced by the risk of fraud or misstatements for the financial account being tested. Any deviations or comments that result from these procedures are followed up on, which may lead to further sampling and additional audit testing to ensure the account is properly stated. It's good practice to have good communication between the auditors and the company throughout audit planning and execution. It sets expectations for the outcome of the audit and gives the company a chance to provide information to correct or provide answers for audit discrepancies, which might otherwise cause a qualified or adverse opinion. The final audit opinion shouldn't be a surprise to the company. Auditors usually communicate with the company about the appropriateness of the company's accounting policies, difficulties they encountered during the audit, uncorrected misstatements, disagreements with management, and any other significant findings. Public companies have audit committees, which are required to meet at least annually with the auditors, and the auditors are required to discuss these items with the committee. The management representation letter is a required part of any audit and also serves as evidence of the audit. It's where the company's management affirms its belief that the financial statements are presented fairly and comply with GAAP. It's signed and dated by management on company letterhead as of the completion date of the audit. The final deliverable in the audit process is the audit opinion, which we cover in the next section.